Batman, we make directional flies, but we put them on either side of the market. So we put one here, and then we put one here, like that. So now when we get into the trade, our profit curve will look something like this, really flat and across like that, right? That's generally how we get into it. Now, what will often happen is as the day goes on, this profit curve starts bulging on the sides like this, and then dipping a little bit in the front like that. And then as it goes on, it will look like this, and then start dipping below like that. And of course, this is our risk. And this is the risk, the additive risk from butterfly 1 and butterfly 2, or left, right, or put, call butterfly, right? And so if price starts here, we don't know if it's going to go this way or this way. Every once in a while, it'll stay like right about here in this area. But that's the average where it will stay, but it's not necessarily where it will stay that day. It's more likely that it's going to be somewhere out here or here or out here. And here's like the likelihoods of where it's going to end up. But more likely it's going to end up either on the put side or the call side. And when it does, that's our opportunity to profit. There's not a lot of profit to be made in this area here. If we don't get outside of this area right here, most of our trades are going to be close to break even or tiny losses. So they tend to wipe each other out. And that's where we make our graceful trade. We have a very simple rule. Now on the old butterfly, on this guy here, this risk to reward would, as I said, be like 1 to 9. And so if this was the 1 and this was the 9, we don't pay much attention if price, hangs out way out here. Matter of fact, we just let it go. But once it starts getting into here, then we start paying attention to it and we manage it. So we're managing our profits, not our risk. That's the ultimate there. But this is a 1R risk situation right around here. Now you go to the Batman. Now this is 2R, that risk there, because it's additive of the put and then the call fly. So what we do is we just wait for, if we're sitting in this box area here, and it doesn't want to move out of there, which is not very often, then we wait for it to drop 50% of the risk, which compared to this strategy, where that's the whole risk right there, that's 100% of the risk. Right? So that's how we exit gracefully. We accept that loss. It's very small. It's our defined risk, and that usually happens before 12 noon. Let's see, we'll use another color here. Let's use blue. By 12 noon, we usually have some resolution. It's either going to be in this area or not. If it's in this area, we take the loss. If it's outside of that area, we're in profit now. So if it's out here or over here, we're in profit. So there's not a lot of thinking that we have to do. These trades here comprise about 50% of the trades. They're going to be either flat or slightly negative or slightly positive. And they kind of cancel each other out. That's the reality. And it's more about acceptance than anything else when we talk about gracefully exiting a trade. But it's not hard to take, because what that results in is a super low drawdown, very small volatility in our equity curve, and just an overall sense of peace. Right? And so when we're out here, though, when we're outside of this box, when we're out of the box, this is where the excitement happens. And this is where we are very guarded on our profits. Once we attain a certain level of profit, we want to keep it. And so we mark our high water mark, wherever that happens to be. So if price is here or here or here at some point in the day, and that's the high water mark, we see, well, if it decides to go the other way, there's going to be a certain amount that we'll tolerate before we grab that profit. So if it drops a little bit, like if it comes out to here, then the price drops down to here. So we look at what our high water mark is. Let's say that we're up $300. We might say that, well, depending on the time of the day, and I'll explain that in a second. Let's say that we're in the early afternoon. I'm willing to give up 30% of that. So if it gets down to $210, I'm out. Now, if it were the morning, instead of early part of the day, it might be a lot more lenient. So instead of 30%, I might say I'm willing to give up 50 to 75% of it, because there's still a lot of time left in the day. If it is in the late afternoon, oh, now we're talking, we really need to be very guarded. Late afternoon, I'm not talking 50% or 30%. I'm talking maybe 25% I'm willing to give up, because you have to keep in mind too that as we get further on in the day and that profit curve is starting to fill up, the butterfly at expiration, the steepness of the profit curve is increasing. And what that is that's your gamma risk. And that's telling you that your sensitivity to price movement back and forth is starting to increase dramatically. So you need to protect yourself with that. So you squeeze and you get more restrictive on when you want to get out of that trade. And so it's pretty simple. We look at how much money that we've attained, what time of day it is, and approximately how much we're willing to give up. And when that happens, you just press the button.